It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, it's all about your Memorial Day barbecue. Burgers and potato chips may taste great on your plate, but they're not created equal when it comes to stock gains. So what's the best way to play it? I'm here with John Baumgartner, Managing Director and Senior Consumer Equity Research Analyst at Mizuho. Good to see you. Thanks for being here. So in this case, chips win the day. UTZ is your pick here. And if you look at the stock, it's up on the year, but it's had sort of a little bit of a rocky time. First of all, you say generally salty snacks are doing well right now?
That's correct. I mean, you're seeing a little softness in the category. Volumes are flat to down less than 1%, but compare it relative to chocolate candy, sweet baked goods with volumes down mid to high single digits. And on top of that, those sweet categories should see more price inflation this year from cocoa, sugar. You'll see prices moving higher most likely, and that should even reinforce the position for salty snacks.
Do you have a favorite UTZ product?
Chips.
I, as a Marylander, the crab chips, the UTZ crab chips are the way to go. Gaining market share as well. So UTZ, obviously it's a big category. There are a lot of players here. How is it doing well against its competitors?
Well, when you think about the UTZ geographic exposure, almost 2/3 of sales are from core markets, East Coast, New England, Mid-Atlantic. There's an expansion territory now, almost 40% of sales, west of the Mississippi, central, southern U.S., expanding out through M&A acquisitions, getting on shelf, getting more distribution. We're seeing distribution right now for UTZ mid-single digits, 5 or 6%, helping drive sales as well.
Interesting. And then there's also some restructuring that's going on here. So what does that look like and what is it doing for the company?
Right, so UTZ has laid out a 3-year plan of about 300 basis points of margin expansion. And that involves shuttering lower efficiency factories, investing in AI analytics, better returns on trade promotion.
Oh, I gotta stop you right there. How does a chip company use AI?
A number of different ways, right from the manufacturing assets themselves, listening to vibrations on the machines, knowing in advance when they may break down. So you can either accelerate maintenance or defer it if you don't need it. That's number one. Number two, giving much better insights in trade promotion, getting better lifts on volume, knowing in this geography there's more of a pull for buy one, get one, or buy two, get one, so you're getting better lifts on promo.
Very cool. Because I hear everybody talking about AI all the time, so it's good to know specifically how it's being used.
Yeah, I mean, we even see food companies just using listening tools on the internet, hearing what flavor combinations are popular and using that to inform innovation going forward too.
Very interesting. Okay, so the thing that could potentially go wrong for UTZ here is more a bigger picture issue. It wouldn't be an UTZ specific issue.
That's right. I mean, this quarter we heard a fair amount of concern for low-income consumers. I mean, UTZ's portfolio skews more towards mainstream households to begin with, but it is a concern for the category, and with lower volumes comes more price competition. In salty snacks, we haven't really seen price competition since the financial crisis in the past 15 years. It's a pretty rational category. We think that demand holds up. Again, even sweet snacks are even weaker at the margin, so we think you could see more consumption coming from sweet into salty this year, and the share gains by UTZ with new distribution also should reinforce sales for them.
Are we continuing to see pricing go higher when it comes to this category?
It's flattened out now for the most part. I mean, you've typically seen low single-digit pricing historically. The product mix is another lever as well. Changing pack sizes, more single-serve packs. Soft drinks have done a very good job of that over the years. Salty snacks moving towards that approach as well. So pack size is a big benefit. We don't have to necessarily raise the list price increase. Smaller pack size, higher price per pound, that gets the job done as well.
Gotcha. All right, so let's talk about the stock that you would avoid here, and it's in the burger category, specifically the plant-based meat category. It's Beyond Meat. The stock is already down a lot, but you're not nibbling here, so to speak. And there's demand weakness that we've been seeing this for a while.
Yeah, I mean, category volume has been down for 40 straight months now through April, and that's more or less priced in. But our concern at the margin is strategy and competition. If you look at strategy in 2023, when the industry took prices up during inflation, Beyond took prices down. Now they're raising prices into a down market. We're seeing pricing on the shelf now up 10% year on year already in April. Price increases went through last month. We're very concerned over larger elasticity, another leg down for volume for Beyond Meat. I mean, back in 2020, their market share was north of 20%. Now it's down to about 14 to 15. We see more downside risk there, and that's compounded by competition. We're seeing Impossible Foods, really, I think, revitalizing their business. Relaunch in effect now, launching new flavors, some spicy varieties that are out there, gaining more distribution, plant-based chicken in the Whole Foods now, as of this month. So we think, that combination of higher price for Beyond, more elasticity, more competition from Impossible, we see downside to revenue this year.
All right, and then let's talk about what they might need to do on the capital side, that there might be some sort of capital raise that would dilute equity.
That's right. Cash burn here is still very strong. I mean, we model about $100 million of cash burn this year, down from $120 million last year. So it's an improvement year on year, but with $160 million on the balance sheet at the end of Q1, that burns pretty quick. So, our sense is they will have to do some sort of a capital raise this year. At a $6, $7 stock price, it could get really dilutive really quickly with 65 million shares outstanding.
So what could go right for Beyond Meat? And I guess new stuff that's going to get people to buy?
New stuff. You see the launch of Beyond version 4.0 with avocado oil. The company has received some accolades from the American Heart Association, American Diabetic Association, with the avocado oil as an ingredient, reducing saturated fat, reducing sodium. That's rolling out into the market for this spring and this summer. That could drive a bit, a recovery in market share, stronger sales from here for the duration of 2024. International, they have been growing internationally with distribution, especially in food service with McDonald's over in Europe. That could be a positive as well.
Any position in either of these stocks?
No.
Okay, just had to ask. All right, so you say people should buy us, avoid Beyond Meat. Very appropriate going into this holiday weekend. Thanks a lot, John. Good to see you. Thanks so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.